This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Surprise, prices are rising. Inflation is here, but investors shrug it off, sending the Dow up more than 250 points.
Hunting for yield as inflation ticks higher. Not all dividend stocks are created equal, and it may be time to get more selective.
Behind the wheel, are you driving one of the most dependable cars on the road? Those stories and more tonight on Nightly Business Report for Wednesday, February 14th.
Good evening, everyone, and welcome. Well, if you do not understand this stock market, join the club. I don't either. 2 weeks ago, one of the most violent sell-offs in years was triggered, or so the Swamis say, when the monthly jobs report suggested that inflation would rise. Well, today we learned that inflation did rise. So what did stocks do? They went up. Maybe it's all just a case of turning that old market adage inside out. In this case, sell the rumor, buy the news. After a stumble out of the gate today, equities rallied and strongly for a fourth straight session. The Dow Jones Industrial Average advanced 253 points to 24,893. NASDAQ added 130, and the S&P 500 was up 35. Bob Pisani mightily tries to explain why stocks went up today when most thought they'd go down.
Is the market worried about inflation or not? Stocks took a nosedive on February 2nd when the jobs report pointed to stronger wage growth. It fell early today when a read on consumer inflation came in stronger than expected. But by late morning, the market had recouped all of its losses and it moved higher. Now, what happened? Well, first, volatility has been a big worry recently. And today, the main measure of volatility, the CBOE Volatility Index, or VIX, dropped dramatically, indicating traders who make bets on volatility were betting that volatility would be lower in the next month. That relieved a lot of people. That's one. Second, if you look at the composition of the rally, there's a pattern. First, because interest rates are up, bank stocks, which would benefit from higher rates, have outperformed recently, while interest rate sensitive groups like utilities and real estate have been down. This all makes some sense. And while the markets are down this month, growth stocks like technology and industrials are not down as much and outperformed today. That's good news because it means the growth story is intact. It means traders still believe that the global economy is expanding and that earnings will be holding up. That's the growth story. And indeed, earnings are holding up. In fact, they're not just going up, they're going up for the first quarter, second, third, and fourth quarters of 2018. The bottom line, 10-year yields going up from 2.5% to 2.9% in a few weeks. That's been a bit of a shock to everyone, but it may not be enough to derail the growth story that is the true driver of the markets. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So what was it about that inflation number that caught the market and investors off guard? Steve Leisman digs deeper into the report.
Markets were gripped by a sudden inflation panic this morning when the government reported that the consumer price index leapt by 0.5%. Even taking away volatile food and energy prices, it rose 0.3%, both more than expected by Wall Street. The fit of panic set Dow Jones futures down nearly 500 points in 3 minutes. But then Wall Street seemed to take a breath and reconsider. Maybe it was the benign year-over-year inflation rate, just 2.1%, or the same as last month. Or maybe it was the idea that one-time items like a strange 1.7% rise in apparel costs in a single month were unlikely to repeat. Whatever the reason, markets collected themselves and collectively ignored the inflation threat to surge as many as 200 points during the day. So who had it right? The morning inflation Cassandras or the later day Pollyannas?
It's important to keep in mind that nothing over the last 2 weeks, so the elevated volatility, signs of inflation creeping back in, none of those represent existential threats to this economic expansion and to this bull market. What you've had is a series of growing pains from real interest rates coming off of historical lows. Growing pains associated with inflation expectations reviving after a period of also, very low levels.
Inflation does seem to be firming. With low unemployment, higher wages, and plenty of stimulus from tax cuts, it's likely that inflation will go higher from here. But few see runaway inflation or a Fed that will hike much more than 3 or 4 times this year.
We're getting closer to the target, and the economy is still growing very strongly from a starting point of full employment or maybe even a little bit beyond full employment. So in that environment, I think the Fed's going to keep doing what they've been doing, which is tighten once a quarter.
For now, that's a difference between a Fed that raises rates by 3/4 of a point or a full percentage point. That's maybe why cooler heads prevailed. It's enough of a difference to worry about, but maybe not for a full-fledged panic. For Nightly Business Report, I'm Steve Leisman.
A number of key sectors across the economy are feeling the impact of rising prices. Morgan Brennan with a look now at where inflation is hitting hardest.
If you're wondering whether inflation is picking up, look no further than recent earnings. From construction equipment to food to travel, companies across industries are reporting higher costs, both for materials and for labor. Take Whirlpool, which recently warned higher commodity costs to make home appliances will shave hundreds of millions of dollars off profit this year.
We just see the inflation trends creeping in on many parts of our value chain.
And Whirlpool isn't alone. Caterpillar, Ford, Harley-Davidson, and Sherwin-Williams are just a few of the manufacturers grappling with a tighter labor market and more expensive materials as economic growth ratchets up. After years of concern that stagnant wages and cheap commodities could trigger deflation, the recent increases may be welcome, since some inflation is a good thing. The risk, however, is if it rises too fast.
It looks like it's accelerating. At the very least, all those Fed members who talked and warned about the worries of deflation, all those ideas about deflation in the middle of last year, forget about it. It's gone. Inflation's headed back to the 2% target.
One area to watch, transportation, especially for freight. The price to move goods by truck has spiked, in some cases by more than 30% over the past year. A better economy, a driver shortage, and new regulations are all to blame. But those aren't expected to let up anytime soon. While that's good news for truckers, it's bad news for companies like Tyson, which now predicts higher meat prices this year. But perhaps the biggest signal inflation is emerging lies in telecom. After years of wireless price wars, Sprint and T-Mobile are both considering moves to dial back discounts. A big potential shift for an industry whose falling costs have helped tamp down inflation for years. For Nightly Business Report, I'm Morgan Brennan.
And the head of Goldman Sachs says the risk of the economy overheating is rising. He cited the combination of tax cuts and the potential for an increase in spending at a time when the economy is strengthening and people and companies are feeling pretty good. He made the comments on MSNBC's Morning Joe.
Obviously, the supply side view is that it wasn't at full capacity, and so they're putting a little bit more on. I would say, from my point of view, that wouldn't be the move I would take when, if the fire is roaring and the coals are caught. I don't know that I'd be spraying lighter fluid on it.
Exactly.
Especially if I might need that lighter fluid later.
Well, that's the thing.
When the coals started to die out, because at some point you're not going to take rates much lower than where they are now. You're not necessarily with these deficits going to come up with later, if you ever needed, another stimulus plan, and
right.
Et cetera. So I'd like to have some things in reserve.
So does the economy have the potential to overheat? Joining us to talk about that is Russell Price, senior economist at Ameriprise Financial. Mr. Price, welcome. Good to have you with us. What do you think? I mean, there was one of the most respected names in American finance, Lloyd Blankfein, saying he's a little worried about all of the stimulus that is in the system. Are you?
I do think that the stimulus that we've seen does stand the potential to add a little bit more inflation to the economy, and that'll shave off some of consumer purchasing power. And it does come at an unusual time when the economy has been doing quite well. Over the last several years, people have been complaining about the economy doing a little bit being frustratingly slow. Mm-hmm. And it's been still strong enough for the unemployment rate to come down at a steady pace and inflation to remain in check. Now, this year, if we do see it exceed maybe the 3% level, if inflation takes off some of that purchasing power from consumers and businesses, there's some argument to be made that maybe we wasted a little bit of the stimulus that we may see this year and next year.
But if the inflation rate hits that 2% target, isn't that what we've wanted it to do? We've been waiting a long time for it to do just that. I mean, it would seem as though that would be a good thing.
Yeah, and 2% on the core rate, I think, is our standard outlook. We think it might be a little bit more than that by 2019, but generally we do think that that is the pace. So we're not exactly in the camp where we think that inflation is going to overheat anytime soon. We think that some of the fears and concerns may be a little bit ahead of themselves. but certainly we are seeing wage inflation. But there's one big difference today than historically when we've seen wage inflation, particularly since the 1970s, and that is usually companies have to pass those higher wages on to customers in order to maintain their margins. This time around, they just got a big, very sizable tax cut, so they have plenty of ability to pass on higher wages and still maintain their prices, and still should end up with higher profit margins.
Is there anything that consumers or investors should be doing? Because many of them have never lived through an era where interest rates were rising in any kind of sustained way, not that they're going to get really way out of hand, or that inflation has been a factor at all.
Right. I think generally speaking, there are still an awful lot of dynamics in the economy that are very likely to contain inflation, not just over the next few years, but for the foreseeable future. Things like demographics and slower population growth and aging societies and technology, the ability of technology to keep prices in check, those are very powerful dynamics.
Right.
I think that what the consumers basically can do is not really worry about it all that much. There is going to be an adjustment phase for financial markets as they evaluate the data as it comes forth, like we've seen. But other than that, I don't think that this too shall pass and should move on.
You're going to let me sleep tonight, Russell. Thank you. Russell Price with Ameriprise Financial.
A number of stocks tend to rise when inflation runs hot. According to one study that examined data back to 2001, the top performers in the Dow 1 week after a stronger than expected report on consumer prices include the following: United Technologies, Apple, United Health, and Boeing. On the flip side, DuPont, Procter & Gamble tend to fall 1 week after an inflation report tops expectations.
Time now to take a look at some of today's upgrades and downgrades. Target's rating was raised to outperform from neutral at Baird Equity. The firm says Target stands to benefit from remodeled stores and its acquisition of Shipt, a same-day delivery company. The stock's price target was increased to $85 from $75, and Target shares rose 2% to $75.35. Avis Budget Group saw its rating cut to sell from neutral by Goldman Sachs. The firm cites mounting headwinds like increased competition from ride-sharing companies and rising interest rates. Price target there cut to $33 a share. Shares of Avis fell more than 3% to $38.73.
MKM Partners raised its earnings and revenue forecast for Facebook. The analyst is urging investors to be aggressive buyers of the stock. The firm reiterated its buy rating and also its $240 price target. Shares rose more than 3.5% to $179.52. Fossil Group saw its price target raised to $25 at KeyBank. The analyst says Fossil's focus on wearable technology will lead to higher margins. Fossil reported better than expected earnings late yesterday. The earnings report helped fuel today's 87% rally in that stock.
And still ahead, Cisco's streak is over, and investors are cheering.
Cisco is seeing a return to growth. It ended 2 straight years of revenue declines. The Dow component reported earnings and revenue that topped expectations. It also hiked its quarterly dividend and authorized a share buyback. Investors liked the results, sending the stock initially higher in after-hours trading. Josh Lipton has more on Cisco's quarter.
A positive report from Cisco across the board. It wasn't just the beat on the top and bottom. Also, gross margins came in better than expected at nearly 65%. Infrastructure platforms, the company's bread and butter core networking offerings related to switching and routing grew 2%. Michael Genovese of MKM Partners also highlights the board's decision to approve a $25 billion increase to its stock buyback program enabled by the company's huge cash pile parked overseas, which it can now bring back thanks to recent U.S. tax reform. Genovese says that means Cisco is buying back a lot of shares, which will drive earnings estimates meaningfully higher. For Nightly Business Report, I'm Josh Lipton, San Francisco.
AT&T reportedly wants a top antitrust official at the Justice Department to testify during its merger trial. As first reported by the Wall Street Journal, the move is designed to challenge the legitimacy of the government's lawsuit The government sued AT&T to block the telecom company's $85 billion merger with Time Warner. AT&T has previously questioned the department's motives. The trial is expected to start mid-March and represents one of the biggest antitrust cases in a generation.
Fannie Mae may require a taxpayer-funded bailout. This after the mortgage finance company reported a loss of $6.5 billion in the fourth quarter of last year. That loss could trigger the first cash infusion into the company in 6 years. Fannie Mae has been under government conservatorship since the financial crisis.
The Trump administration has proposed reducing the time it takes to permit infrastructure projects and has pointed to a bridge that connects New York and New Jersey as an example of red tape and bureaucracy run amok. Kayla Tausche reports tonight from Bayonne, New Jersey.
Feet above the Kill-Van-Col Strait, construction continues to expand the Bayonne Bridge. The project raised the bridge by 64 feet to let bigger cargo ships pass. It won't be fully completed until 2019. At that point, the $1.6 billion project will have taken nearly a decade. Some blame the permitting process and say speeding that up would get businesses to invest.
The bottom line is, right now, it's taking too long, and it's not getting 20% of the cost of a project is now in the planning approval process and not in actually investing in the infrastructure itself.
The American people.
The White House this week released a two-part blueprint for infrastructure, $200 billion in funding, coupled with goals to simplify permitting.
This framework will lead to a $1.5 trillion investment in American infrastructure, a faster permitting process that takes 2 years instead of 10 years and maybe less. We're looking to get it down to 1 year.
In practice, it's more complicated. The Bayonne Bridge review was conducted by one federal agency, the Coast Guard, which completed its permit in 26 months. Its construction and engineering took 6 years because of heavy traffic and harsh northeast winters.
The median time to permit the country's largest infrastructure projects is 3.5 years, according to the Department of Transportation. That's nearly cut in half since 2011. Amy Goldsmith, the New Jersey Director of Clean Water Action, says further shortening the review time would hurt local communities.
There would be little to no mechanism for the public to be engaged because these are complicated projects that require scrutiny.
Others say permits are meaningless if there's no money to pay for the projects. The White House has proposed steep budget cuts in divisions building infrastructure like the Army Corps of Engineers.
All they need is the money. And the Army Corps has $5 billion a year, so the problem isn't the permits or the environmental reviews, is where's the $85 billion?
In just the first year with larger ships passing under the bridge, the busiest ports on the eastern seaboard had a record year, processing 5% more cargo, with future growth expected to climb. For Nightly Business Report, I'm Kayla Tausche, Bayonne, New Jersey.
And to read more about the infrastructure permitting maze, head to our website, nbr.com.
Bristol-Myers Squibb enters into one of the largest drug collaboration deals ever. That's where we begin tonight's Market Focus. Bristol-Myers said it will pay Nektar Therapeutics nearly $2 billion in cash and stock for the right to its experimental cancer treatment. Depending on the drug's success, Nektar could also receive an additional $2 billion from Bristol-Myers. Shares of Bristol-Myers Squibb climbed 2% to $65.35. Shares of Nektar Therapeutics popped 11% to $84 even. The advertising firm Interpublic Group reported revenue growth in its latest quarter that easily surpassed expectations. That company faced weaker client spending for much of 2017, but expects that trend to reverse course this year. Interpublic, which also topped earnings estimates, forecasts organic revenue to rise as much as 3% this year. The shares rose 10% to $24.49. Increased marketing and a growing user base translated into higher profits over at Groupon. But they weren't high enough, and they missed analyst estimates. Groupon also continued to scale back its presence in some international markets, and it issued a disappointing forecast. The shares plunged 9% to $4.71.
Hotel operator Hilton said an increase in overall bookings and strong growth in its international business helped quarterly profits outpace forecasts. Sales were also better than expected. Hilton shares were up 3%. They finished the session at $85.97. And after the bell, Marriott reported stronger than expected revenue as the hotel operator said results were helped by an increase in more expensive bookings. Profits, though, slipped from a year earlier. Marriott shares initially lower in the extended session, but they did end the regular day up 3% at 145.24. And according to a regulatory filing, Warren Buffett's Berkshire Hathaway took a new stake in Teva Pharmaceuticals, valued at more than $350 million. Shares of Teva initially rose in the after-hours trade, adding to a 4% gain during the regular session when shares closed at $19.33.
As we discussed earlier, inflation is inching higher, and when that happens, dividend stocks have the potential to become less attractive to investors. So what should you keep in mind when investing in dividend-paying companies? Here to walk us through that is Teague Sanders, Senior Vice President and Senior Portfolio Manager over at Whittier Trust. Nice to have you here, Teague. Welcome.
Thanks for having me.
What are some of the basics that you should look at in the environment that we find ourselves in now when you're considering whether to add a dividend-paying stock to your portfolio?
Well, I think the thing to remember that's important is that you want to focus still on the fundamentals of the company, right? The dividend should almost be ancillary to what it is that you're investing in. So there are a few things that we do look at, though. We want to focus on low payout ratios, so the percentage of net income that's being utilized for dividends. We want to look at coverage ratios, right? So how much cash flow is available to pay out the dividend. We also want to be mindful of leverage ratios. So companies that are highly indebted will tend to have higher debt service costs as interest rates do rise. And finally, dividend growers. So companies that grow dividends over time will likely continue doing that again in the future.
All right, you used some technical terms there. Let's cut to the chase, and I don't blame you for it because that's what you do for a living. Tell me where I find companies that have these particular attributes today, and by comparison, describe some of the companies where the dividend or the fundamentals aren't as healthy in a rising interest rate, rising inflation environment.
Absolutely. So in this type of environment, as we saw earlier in the show, we want to focus on financials, banks specifically. So interest margins have basically compressed to zero since 2008. And as rates do rise, it means banks will be more profitable over time. Additionally, financial institutions like Prudential should benefit because life insurers have longer dated assets and longer dated liabilities, so they should benefit as well. Additionally, we're seeing deregulation in this space, and so as more capital becomes available for share repurchases and dividends as regulations come off, we should see that come back to shareholders as well.
We showed some of the stocks you like. Let's start with McDonald's. You don't own it directly, but why would that make the list?
Well, McDonald's is a great story about being able to take advantage of changes in consumer behavior. They've done very, very well when it comes to taking advantage of food delivery. The dinner portion of that delivery is really increased. And what's funny is that people order more desserts at dinner time when they have it delivered. And McDonald's also says that they've figured out fresh French fry delivery. So stay tuned on that. And then again, Prudential is the other one that we're looking at closely for the reasons we talked about. Deregulation. They're currently labeled a systemically important financial institution. And if that SIFI designation comes off, it'll free up a lot of capital to come back to shareholders in the form of dividends and share repurchases.
All right, Teague, thank you very much. Pleasure. Teague Sanders with Whittier Trust. And coming up, the most dependable cars on the road today.
A new study shows that cars and trucks are more dependable than ever. J.D. Power's annual survey of people who own 3-year-old models also points to an interesting trend. Mass market brands are closing the quality gap with luxury ones. Phil LeBeau has the details.
It may be the most important question people buying a car or truck will ask themselves in a showroom. How reliable is this model? J.D. Power's annual survey on vehicle dependability shows 3-year-old models are holding up better than ever. The brands with the fewest problems? Lexus, Porsche, and Buick, which is the highest rated mass market brand in the survey of more than 35,000 owners. Overall, mass market brands, including Chevrolet, Toyota, and Hyundai, are closing the quality gap with luxury lineups. So while Porsche owners still report fewer problems than those driving other, more common models, the difference between the two is shrinking. What's not changing is the frustration owners are experiencing with in-car infotainment systems and features like voice recognition. This remains the top complaint according to J.D. Power. The bottom 3 brands in this year's survey, Fiat, Land Rover, and Chrysler, which declined to comment on the results.
So if an automaker struggles or does well in a survey like this, does it hurt or help sales? Well, maybe not immediately, but J.D. Power points out that vehicle dependability is becoming more important than ever for those looking to buy a new vehicle. Phil LeBeau, Nightly Business Report, Chicago.
And before we go on this Valentine's Day, Americans are expected to spend a near record amount. The National Retail Federation puts spending at close to $20 billion. Much of that will be on jewelry, yes, followed by a night out at dinner. No. Flowers, yes. Candy, and get this, more than $600 million will be spent on gifts for coworkers.
Here's a look at one more look at the gains in stocks today. The Dow advanced 253 points to 24,893. The Nasdaq added 130, and the S&P 500 was up 35. You're always so good on holidays to your lovely wife. Happy Valentine's Day to you too, and to all of you. That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Tyler Matheson. Have a great Valentine's evening, everybody, dinner or not. We'll see you tomorrow.